If you are an investor, a property developer, or running a listed company in Hong Kong, listen up. Your compliance baseline for the next decade just got a fundamental rewrite.
That's right. We're doing a deep dive today into the updated Biodiversity Strategy and Action Plan, or BSAP, which the government officially dropped on December 31st, 2025.
And while the name sounds, a bit niche, a bit environmental,
it's not. This 10-year playbook running to 2035 is probably one of the biggest pieces of regulatory news for the real estate and finance sectors we've seen all year.
So it's formalizing nature loss, moving it from some external theoretical risk into something that hits the balance sheet, a real compliance hazard.
Exactly. It's all about integrating ESG risk right into the core of the economy.
Okay, let's unpack this immediately, because in a place like Hong Kong, land scarce, development heavy, the stakes are just enormous. What is the fundamental mission here? What's the big idea behind BSAP 2035?
The mission statement is actually pretty simple, but it's profound. They want a concrete plan to achieve real harmony between humans and nature.
And this ties into the mainland's philosophy, right? The whole lucid waters and lush mountains are invaluable assets idea.
It's a direct alignment with that. But, underneath that philosophy is a very detailed and very mandatory implementation plan.
So give us the snapshot. How is this blueprint actually structured?
It's built around 4 key strategic areas, and you should really think of these as the 4 big levers the government's going to be pulling for the next 10 years.
Okay, what are they?
First up is nature conservation. That's the traditional part safeguarding ecosystems, restoring species, the stuff you'd expect.
Right.
Second, and this is the one that's crucial for our audience, is deepening mainstreaming.
Deepening mainstream.
Yeah, it's all about embedding biodiversity requirements across every key economic sector: property, finance, infrastructure, you name it.
Okay, that's the one with the teeth. What are the other 2?
Third is capacity building. So advancing the knowledge, the professional expertise, and really importantly, the technology needed to comply with all this.
And the last one?
Collaborative partnering. Strengthening regional cooperation, especially within the Greater Bay Area.
And the plan includes 30 priority actions and 81 priority projects. Yeah. It's a ton of regulatory work. So why the urgency? Why now?
Well, the drivers are coming from everywhere, really. Both global mandates and some pretty alarming local facts.
Okay, let's start with the global picture.
Globally, Hong Kong has to align with the Kunming, Montreal Global Biodiversity Framework, the KMGBF. China's presidency was key to that, and it set 23 massive global targets.
And I assume there's pressure from the mainland's own national strategy as well.
100%. The national plan for 2023-2030 specifically called out the GBA region as a strategic priority for conservation. Hong Kong was never going to be exempt from that.
So alignment is a huge factor. But that doesn't usually trigger such a massive overhaul unless the data on the ground is screaming for it. What did the reports actually say about Hong Kong's own biodiversity?
And this is where it stops being about policy and starts becoming a very clear financial risk signal. The State of Hong Kong Biodiversity 2025 report from last March, that was the real catalyst.
Right.
The data is, it's sobering. Of the 886 species they assessed, 21 have already vanished from Hong Kong. Gone.
But what's the headline number? The one that should be on every developer's desk.
It's that over 25%, 232 species are currently at risk of local extinction.
Hold on, 25%. 1 in 4 assessed species is at risk of disappearing from Hong Kong.
That's the number. It's an environmental catastrophe in the making, and frankly, it's a financial time bomb.
Which groups are under the most pressure?
The report points directly to birds and freshwater fishes, which makes sense, right? It reflects that high conflict development happening in valleys and wetlands.
And they mapped the specific locations of this risk, I assume?
They did. They identified 27 critical terrestrial biodiversity hotspots. Now get this. These hotspots cover just 6% of the city's land area.
Only 6%?
But, and this is the kicker, they contain about 95% of the species facing that extinction risk.
6% of the land holds almost all the risk. That is a massive concentration. That's a huge signal for land valuation and, stranded asset risk.
Absolutely. And if that wasn't enough, here's the finding that should concern anyone holding a land bank.
Go on.
Nearly 50% of those 27 critical hotspots, they overlap with land already zoned for committed or planned development.
50% overlap.
Almost half. So this isn't some theoretical, far-off problem. This sets the stage for immediate, expensive, and legally complex clashes between developers and regulators, starting now.
Okay, let's drill down into that compliance playbook, that deepening mainstreaming pillar. If I'm a developer, what are the biggest changes I need to get my head around?
For developers, the absolute game changer is the new emphasis on the avoidance-first approach. And tied to that, the formal move to incorporate biodiversity net gain, BNG.
BNG. Break that down for us, because that term fundamentally changes project economics. It's not just about minimizing damage, is it?
Not at all. It means you have to leave nature demonstrably better off than it was before you started.
So how do you even measure that? How is it enforced?
That's the core shift. It's about quantification. A developer now has to measure the biodiversity value of a site using quantifiable biodiversity units before they even break ground.
Okay.
Then they have to design the project to generate a net positive number of those units when they're done. And if they can't do it on site,
They have to pay up.
they have to buy off-site biodiversity credits or fund recovery projects somewhere else. It introduces a whole new variable cost to every project.
A cost that can change depending on how rare the ecosystem is.
Yeah,
That sounds like a recipe for delays and massive compliance headaches.
precisely. And the government is closing every loophole to enforce this. The new guidelines will be integrated into everything: the town planning ordinance, the environmental impact assessments,
The EIAs are getting stronger.
much stronger. And they're now mandating pre-development biodiversity surveys even for smaller projects that used to fly under the radar. No more cutting corners, especially near those 6% hotspot zones.
So the due diligence bar just went way up. Okay, let's pivot to the financial sector. If nature risk is now a regulatory factor, is Hong Kong forcing companies to report on it?
Absolutely. The government is throwing its weight behind global frameworks like the Task Force on Nature-Related Financial Disclosures, the TNFD.
So we should think of TNFD as the new TCFD, but for nature risk instead of climate risk.
That's the perfect analogy. TNFD forces companies to look at how their business depends on nature and how their operations impact it and what risks that creates.
And where does the enforcement come from?
The regulatory hammer is the clear expectation that the Hong Kong Stock Exchange, the HKEX, will review its listing rules, specifically Appendix C2 on ESG reporting.
To mandate nature-related disclosure.
Exactly. This is the signal that nature risk is moving from a voluntary nice-to-have to a mandatory disclosure requirement for every listed company.
Which forces it onto the radar of every bank and asset manager. Okay, let's talk funding. How is the government planning to mobilize the capital for all this?
Well, first, they're strategically linking nature to the climate agenda. They're positioning nature as part of the climate solution in the next climate action plan.
So they can tap into climate finance streams.
Right. They're encouraging things like blue bonds and biodiversity bonds, and they see the HKEX's core climate platform playing a role in quantifying carbon credits from local habitats like mangroves.
Trying to create new tradable assets based on nature. That requires an incredible amount of trusted data.
It does. And they've also suggested the government sustainable bond program could fund some of the big public projects, like building out that centralized biodiversity GIS database we mentioned.
Speaking of public money, we saw the AFCD's budget estimates. What did the actual conservation spending look like?
The budget for nature conservation is about 1.078 billion Hong Kong dollars. It's an increase of 3.8%.
3.8%. I mean, that feels modest given the scale of what they're proposing.
It is modest, and I think that's a huge signal in itself. It suggests the government expects the private sector, the developers, the listed companies, to bear the majority of the new costs for compliance and data collection.
The government writes the rules, but the market pays to play.
That's the model. Now, there are some buffers. There are still big balances in the sustainable agriculture and fisheries funds, over 800 million and 700 million, respectively.
Okay, so there are pots of money available for specific projects.
Exactly. It provides some stability, but the big recurring costs are shifting to the private sector.
This brings us perfectly to the intersection of risk, data, and compliance. Let's transition to our not financial advices segment. Based on everything we've discussed, what's the outrageous but plausible trade idea you're seeing?
The thesis is pretty simple. The combination of these super strict new rules, avoidance first, mandatory BNG, creates a sudden, massive demand for technology, specifically for impartial, defensible data capture.
Because the old way of doing things, manual surveys and so on, just won't cut it anymore. It won't stand up in court.
Not against these BNG requirements. So you have regulatory risk creating an enforced tech upgrade cycle.
All right, lay it out for us. What's the trade?
It's a pair trade, nature tech versus stranded assets. On one side, you go long a basket of listed firms that are pioneers in scalable environmental monitoring.
What kind of tech are we talking about here?
We're talking high-fidelity data collection, specialized drones with hyperspectral imaging, advanced bioacoustics monitoring, environmental DNA sampling, eDNA.
And why these specifically?
Because that big central database, the BGIS, needs standardized, impartial data to function. Only scalable tech can provide that. This trade essentially targets a mandatory tech spend that's being funded by the developer's new compliance costs.
That's a strong case for the long side. What's the short?
The flip side is a short position on highly leveraged property developers, specifically the ones whose main land banks are sitting right inside those 27 newly mapped biodiversity hotspots.
So you're targeting the firms with the most debt and the most ambitious plans in those 6% conflict zones.
The ones who bet big on land that has just become regulatory quicksand. Remember, almost half that land was already slated for development.
And the new B&G rules introduce huge, unpredictable risks for them.
Exactly. Project cancellations, forced redesigns, massive delays, or just punitive offsite compensation costs that kill their margins. The market has not fully priced this in yet.
It's a classic trade on regulatory risk hitting leveraged balance sheets. Okay, so to wrap this all up,
the entire read here is that BSAP 2035 isn't just a conservation policy. It's a fundamental zoning and due diligence update, just disguised as an ESG initiative.
So what does this all mean for you, the listener? The key takeaway is that nature-related risk in Hong Kong is now a non-negotiable regulatory and financial factor. The compliance baseline has shifted for the next decade.
And investors need to watch those 4 strategic areas we mentioned. That's where all the future regulatory tightening is going to come from. The very next thing to look for is the new guidance from the HKEX on mandated TNFD reporting.
An excellent synthesis. And as always, we have to say it, the trade idea is purely for discussion and to connect the dots.
Yeah.
We're analysts, not your investment committee.
This is not financial advice.
Right.
But if this deep dive proves anything, it's that in the very near future, a company's credit rating might depend just as much on its biodiversity data as it does on its balance sheet. Nature risk is now an integrated debt liability.
Thank you for tuning in to The Deep Dive. We'll catch you on the next deep dive into the source material.